Allocation funds, which hold a mix of different assets, can be a great core holding for many investors, but not all are created equal. We asked Morningstar Manager Research Analysts to share 3 of their favorites across categories.
Gold-rated Fidelity Four-in-One Index is proof that a basic, straightforward approach can yield fantastic results. As its name indicates, the fund combines 4 index funds into one allocation fund that targets 85% equity, meaning the fund may be more appropriate for growth-oriented investors with a longer time horizon. The fund makes use of U.S. equities, international equities, and U.S.-based fixed income. The fund has a long track record with solid performance in its peer group. Adding to the appeal is that the fund has the cheapest expenses in its category at only 11 basis points. Add it all together, and investors have a solid recipe for success.
Gold-rated Dodge & Cox Balanced is a great option for patient investors that are willing to stomach some shorter-term volatility. The fund is led by Dodge & Cox's U.S. Equity and U.S. Fixed Income Investment Committees. Each committee is composed of 8 members who have been with the firm for more than 20 years on average. That helps to reduce key manager risk. By prospectus, the fund's equity stake can range from 25% to 75% of assets. It's been towards the higher end of that range in recent years, though the equity stake has decreased to about 65% of assets as of June 2017. The allocation is determined by relative valuations, and the portfolio is built with a 3 to 5 year investment horizon in mind. All told, the fund's decisive value approach, combined with the rock bottom fees that it charges, have contributed to its long-term performance record. It remains a great option going forward.
Vanguard Wellesley Income is one of our most solid options in the allocation 30 to 50% equity category. It's got solid experienced management, very low expensive, and consistent strategy on both sides, on both the equity and fixed income side of the fund. It invests in about 60 to 65% bonds, usually high-quality corporates, and about 30 to 35% in equities, usually dividend-paying stocks, which have a higher yield than the S&P 500, but are not at the extremely high-yield end of the market, so they're not quite as risky as the most high-yield equities out there. This has proved to be a good combination for the fund over a long time, including periods when interest rates are rising, such as from 2004 to 2007, when the Fed rate jumped from about 1% to about 5.25%, and during that period, the fund outperformed its category by a significant margin. Not to say that there isn't interest rate risk with a portfolio that invests this much in bonds and high-yield stocks, but over time, this fund has done an excellent job of controlling risk and is still worthy of its gold analyst rating.